Economics, Standard 11, Unit 4, Cost and Revenue Analysis. Let us learn today cost analysis. Under cost analysis, cost concepts. Cost and revenue analysis refers to examining the cost of production and sales revenue of a production unit or firm under various conditions. The objective of a firm is to earn profit and not to make loss. Then, what is cost? Cost refers to the total expenses incurred in the production of a commodity. The functional relationship between cost and output is expressed as cost function. So, a cost function may be written as C equal to. So, cost function may be written as C equal to function of Q. Okay, so a cost function can be just written as C is equal to function of Q, and where C is cost and Q is quantity of output. So cost functions are derived functions because they are derived from production functions. So that's what they are known as derived functions. Now cost concepts. There are many important costs. Money cost, real cost, explicit cost, implicit cost, economic cost, social cost, and so on. So money cost, and second, real cost. Third, explicit cost. Explicit cost, and fourth, implicit cost. Implicit cost. Then fifth, economic cost. Economic cost, and sixth, we have social cost. Social cost, opportunity cost, time cost, and so on. So, what is money cost? Production cost expressed in terms of money is called as money cost. So, it is the total money expenses incurred by a firm in production in producing a commodity. It includes the expenditures such as cost of raw materials, payment of wages and salaries, and payment of rent, interest on capital, and expenses on fuel and power, transportation, and other types of production related cost, all included in money cost. These costs are considered as out-of-pocket expenses. The producer has to just pay out of his pocket. So it is known as out-of-pocket expenses. Money cost can be also called as prime cost, direct cost, nominal cost, accounting cost, explicit cost, out-of-pocket cost, suiting according to the context. Then second, real cost. It refers to the payment made to compensate the efforts and sacrifices of all factor owners for their services in production. So it refers to the efforts and sacrifices of landlords in the use of land, capitalists to save and invest, and workers in foregoing leisure. So Adam Smith says, pain and sacrifices of labor is called as real cost of production. And third, explicit cost. Payment made to others for the purchase of factors of production is known as explicit cost. So payment made to others for the purchase of factors of production. It refers to the actual expenditures of the firm to purchase or hire the input the firm needs. Examples: wages paid to the laborers, payment for raw materials. So, explicit cost is also called as accounting cost or money cost. Fourth, implicit cost. Payment made to the use of resources that the firm already owns. So, there is a difference between explicit cost and implicit cost. Payment made to others for the purchase of factors of production, explicit cost. Payment made to the use of resources that the firm already owns is known as implicit cost. A firm or producer may use his own land, building, or even machinery, car, and other factors in the process of production. The value of the own services are imputed and considered for preparing the profit and loss accounts. It is known as implicit cost or book cost. Then we have economic cost and social cost. It refers to all payments made to the resources owned and purchased or hired by the firm in order to ensure their regular supply to the process of production. So that is called as economic cost. So economic cost is equal to implicit cost plus explicit cost. So economic cost can be just called as implicit. It is equal to, economic cost is equal to explicit cost plus implicit cost. Implicit cost. So economic cost is just referred to as explicit cost plus implicit cost. Social cost. And the sixth one is social cost. Social cost. It refers to the total cost borne by the society due to the production of your commodity. It is borne by the firm but incurred by others in the society. It is also known as external cost. For example, air pollution and water pollution caused by the firms, and it affects the society. This is known as external cost. The next important cost is opportunity cost. It refers to the cost of next best alternative use. In other words, it is the value of the next best alternative foregone. For example, a farmer. A farmer can cultivate in his land both paddy and sugarcane in a farmland. If he cultivates paddy, the opportunity cost of paddy output is the amount of sugarcane output given up. So opportunity cost is also called as alternative cost or transfer cost. Sunk cost. The word sunk, past, gone deep inside. A cost incurred in the past and cannot be recovered in future is called as sunk cost. This is historical but irrelevant for that is future business decisions. It is called as sunk because they are unalterable, unrecoverable, and if once invested, it should be treated as drowned or disappeared. For example, if a firm purchases a specialized equipment designed for a special plant, the expenditure on this equipment is a sunk cost because it has no alternative use, and in opportunity cost is zero, and sunk cost is also called as retrospective cost. Next, floating cost. It refers to all expenses that are directly associated with business activities, but not with asset creation. It does not include the purchase of raw material, as it is part of current assets. It includes payments like wages to workers, transportation charges for the power, fees for the power, and administration, and so on. Floating cost is necessary to run the day-to-day business of your firm. Prime cost. All costs that vary with output together with the cost of administration are known as prime cost, the important one. In short, prime cost is equal to variable cost plus cost of administration. And another important cost is fixed cost. So fixed cost does not change with a change in the quantity of output. Fixed cost remains as fixed cost even if the output is zero. It remains the same. It remains the same even if the output is zero. Even if the output is zero. So this is called as fixed cost. So for example, now just think of that. For example, rent of the factory, watchman's wages and salaries, permanent workers' salaries, payments for minimum equipments and machines, insurance, premium, deposit for power, and then also license fee, etc. All these come under fixed cost. So fixed cost is also called as supplementary cost or overhead cost. And the last one is variable cost. These costs vary with the level of output. So the 12th, variable cost. So it varies with the level of output. And the best examples of variable cost are wages of temporary workers and cost of raw materials and fuel cost, electricity charges, transport cost, etc. So variable cost is also called as prime cost, special cost, or direct cost. So we have learned the different types of cost concepts. Let us continue learning short-term cost curves in the next class. Thank you for listening.